Hello and welcome to Trading 5 Talents. In today's video, I want to give an example of a covered call vertical that I traded this past week. In a previous video that I'll leave a link to, I looked at the differences between the traditional wheel and the vertical wheel. And basically that idea was instead of just selling a cash secured put, you would sell a put vertical, or instead of selling a covered call, you would sell a call vertical. And basically I just want to take a look and show you an example of that last part of the wheel, a traditional covered call versus a short call vertical. So remember, just with a short call or a covered call, you would simply sell, you would own 100 shares of a stock, and then you would sell one call for every 100 shares that you own. And the diagram would, look like this. And so that's pretty straightforward. You receive that premium up front. If the price of the shares closes above your call strike price at expiration, then you would be forced to sell your shares at that strike price, but you'd still keep the premium of the call that you sold. Now, the vertical covered call or the short call vertical would look like this, in which you would still own the stock. So you'd own at least 100 shares of the stock. You would not only sell a short call at whatever strike price you want, but also buy a long call at a higher strike price. So you would still receive a credit for this call vertical because you're short on it. You'd receive a credit, but in this case, you don't have to part with your shares if it expires in the money. So you could just put up cash, for example, and that difference in the amount of cash that you would lose would be the widths of the strike prices of the vertical, of the long call and the short call, minus the credit that you received. So that's how much money you would lose. So the short call vertical does have an advantage in that if the share price just, rockets high above your short strike, then you could just lose the money instead of losing your shares if you didn't want to part with your shares. So this is what I'm going to go through, this example of this short call vertical while I'm holding 100 shares. So that's why I'm referring to it as a vertical covered call. So here's the process. I'm going to enter this short call vertical, and if the price moves up shortly, well, first of all, let me back up. I'm going to own 100 shares of the stock. Then I'm going to enter the short call vertical. If the price of the stock moves up very sharply, I'm just going to exit that long call for profit. And then that short call of the vertical is simply going to convert to the traditional covered call. If it doesn't, I'm just going to collect the full premium of the short call vertical. So in either case, I'm going to be collecting premium, but in one case, I'll be able to profit on the long call if the stock moves up sharply. So let's take a look at Mara and what happened with that this week. So here's the candlestick chart for Mara. These are 15-minute candles, meaning that each candle represents 15 minutes of time. All right, so this is what I started seeing in Mara. If I could draw this arrow right here. I saw this increase and we had this huge gap up down here, and then you saw a strong price movement over the course of this particular day. And a strong gap up as well. So there was a lot of strength with Mara going into this trade. And what I did was I purchased 100 shares right here at $16.15 of Mara. So at that dotted line, that's the $16.15 price. I bought 100 shares, and then I had a choice. I could just sell a covered call if I wanted to. And of course, I could have sold it, above my strike price, but I was going for something different. I was going to look to sell an in-the-money covered call. And so I bought it at $16.15, but I was going to sell a covered call at the 16 strike price. So short a 16 call for 85 cents in premium. Now, if this expired in the money by expiration, then I would have gained my $85 right here, and I would have lost this $15 right here. So I have 100 shares at $16.15, but I have to sell them at $16. So I would lose 15 cents per share, and that would be 100 shares. So I'd lose $15. Gain 85, lose 15. This in-the-money covered call would have profited me $70 if it expired in the money. Now, I already made a video about generating easy profits using in-the-money covered calls, and this would be an example of that. $70, and the price could still move 15 cents down, and I would be able to collect that premium. So it's a really good setup. It's a very simple setup to understand. So if you want to check out that video, I'll leave a link to that as well. But I didn't just sell this in the money covered call. I also purchased the 18 call. So I'm long the 18 call that's in green up here. And that was $27. So it cost me $27. So taken together, short one call, and then I'm long another call. This is what's called a short vertical call spread. All right. So I'm short. This is the minus sign, is short the 16-18 call vertical, or a bear call spread. So gain 85 from the short call, pay 27 from the long call. That would be a total of 58 cents per share multiplied by 100, $58 in credit for putting on this trade, this two-legged trade. All right, so what happens next? You can see I entered here at 16.15 on this candlestick. It went up, came back down, and then it gapped up the next morning. And you can see how high it went. It went almost to 1890, I believe it was, for this high point. And as it came down, I was afraid that it's going to start moving, in a bigger downtrend. So I exited this long call. So this green arrow is for this long call. I exited this long call at 49 cents. So I sold to close. So here I'm buying to open for 27 cents, selling to close for 49 cents. So that is a 22-cent gain per share. So $22 in profit. Now, where does that leave us? It leaves us with 100 shares of the stock and this 16 call strike price down here, the short 16 call. So you can see the price action here. It did go down eventually, and I thought, okay, this is going to be a pretty good trade. I timed it pretty good. I didn't get the top. No one rarely ever gets the top. So I was fine with that. I definitely made money on this long call. Now you can see the price action goes down and then it comes back up and it closes above this 18, which again, obviously it closes above 18. It's going to be above my 16 short call. So I had to just let this short call expire in the money and sell my shares at $16, because that's the idea of a covered call. If that short call expires in the money, you have to sell 100 shares of your stock per contract sold at that strike price. So the strike price was $16. I had to sell my shares at $16, but I collected the full premium of the short call. So this expired and I was able to collect that full $85. So taken together, this is what happened. I made $22 or 22, let's just say 22 cents. 22 cents from this long call, the green line. I made 85 cents from this short call, which was this red line, and I lost 15 cents per share from the stock. Again, I bought it at $16.15, sold it at $16, so I'm losing 15 cents per share. So adding all of these together, 92 cents in total credit or total profit, and multiplied by 100, that's $92 that I gained. So if I just sold the covered call, remember, just this red one right here, 85 cents in premium, losing 15 cents in my shares, that would have gained me $70 in premium. I would have gained $70 in premium or profit if I just sold this in the money covered call. That is greater than just selling this call vertical. All right, this short call vertical was only 58 cents or $58 in total premium. But what I did is I combined the covered call with a short call vertical. And again, here I'm just calling it the covered call vertical. And that gained me 92 cents in premium or $92 in total profit. So overall, I was more profitable using a covered call vertical on this particular play than I was just selling a covered call, and definitely than just selling a short call vertical. Now, of course, you could argue if you just would have held the shares, then you would have made a lot more money. You could have made upwards of $200. And yeah, that's true. But again, I didn't know for sure if the price of MARA was going to continue on this upward trend. Yes, it did have a strong move up a couple of days in a row, but here I thought it was definitely cooling off. I did not know that it was going to go up again. So profit is profit to me. I did make $92 on this when maybe I could have made $200 if I would have timed it just right. But in either case, We did make money on this particular trade. I just wanted to highlight it because I wanted it as a follow-up to the vertical wheel. So if you missed the vertical wheel video, then please go ahead and take a look at that. But I just wanted to share this example of a covered call vertical using the stock Mara. So if you have any questions about this trade or about trading the wheel or selling options in general, then go ahead and leave a comment down below, or you can catch me on Twitter at Trading5Talents. And in the meantime, if you'd like to keep up to date with how options trading is paying off my Tesla Model 3, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.